in the transcription, and we'll get started. So I put a few comments in the actual chat, saying that, we're well on our way to test number 2. Test number 2 starts at topic 5, 6, 7, and 8. That's what it's going to encompass. And then we're well on our way to assignment number 3. And I made a point, and I think I sent the post out twice, but have a look at that video and follow that video with the presentation that I created to accompany that video, to be able to go through the instructions and really get a sense of what I'm looking for. Because really what this assignment number 3 is all about is to prepare you, for when you leave this program, to really get a sense of what the challenges around AI will be, because they're going to be tremendous. And already I'm seeing, like I get a lot of articles that come in on my flip that talk about, holy cow, it's happening already and people are being displaced already. So I think that will really prepare you and really give you a sense of, what do you really want to do, especially when you get into creating your personal mission. And that way it really kind of will solidify, your values towards that and your approach and all those things. So I'm hoping that will help everyone. Okay. The next one is, if you're on board here, use your emoticons. If you think that I'm getting too technical or whatever, just show me a sad face. And then if things are good, you show me a happy face. And again, if I'm asking you how we doing, can I move on? You give me the thumbs up, and then I'll proceed. So what I'm going to talk about in topic 6, especially in topic 6, and then somewhat in topic 7, is that it's getting pretty technical. And what I'd like you to do is pay attention to the yellow highlighting and the golden keys that I'm putting in there to really direct you to the key areas of focus, to study for test number 2, right? So that's what it's going to be all about. So we're getting into financial management in topic 6, and again, it's part of what gets measured gets done. So if you don't really understand the financials, then especially if you're running your own business, you'll never really get to that next level of growing your business. And I've done a lot of consulting, for federal development in Ontario when I was in Ontario for 12 years. And what I found is that the small business owners that really understood the numbers were successful, and the other people who didn't understand the numbers, they just weren't successful. And I did an audit on a $3 million revenue assembly business, and the owner manager, he didn't even know if he could make his payroll, month to month, and relied on his accountant. And so that tells you what kind of state of affairs, the financial institution called me up and said, we'd like you to take a look at what this guy does. All right. And the first thing I told him is, fire your accountant, right, and find somebody who knows how to do a controller type accounting, where they'll really get into your business and you'll understand where your money's going and how all the cash gets worked up and stuff. So that's why this topic is important, but it's a bit technical. So I'll keep you to what's highlighted, so that that so where the test questions will kind of come in terms of reflecting that. Okay. So again, the areas of financial management: how should we finance our business? How do we manage the risk? How do we calculate financial ratios? And the thing about financial ratios is that the key ratios that you use depends on the type of business and the type of area that you're in, your footprint, and then how you want to grow your business. So the answer is, it depends. Okay, so different businesses, although they'll look similar, they might have different financial ratios that they use to be able to make sure they're on target. But it all comes down to which vision they're driving towards. Okay, so that's what I'll try to kind of put through. The other thing too is that I'm going to talk to you about balanced scorecard. And balanced scorecard is probably the best tool to be able to manage your business from a from a a key performance indicators point of view. Is it perfect? No, but it's the best thing going. And not only that, when it first came out, it was just for profit businesses that used it. And now all kinds of businesses use it because they see the value in it. And associated with the balance scorecard is the mapping strategy, and that's going to be covered. And again, that's going to be a participation activity to do. And not only that, you'll see that in assignment number 4 when you're working on Amazon, and you'll have the option of answering that. So if you do a really good job in topic 6, then you keep your template, your Excel spreadsheet, for the balanced scorecard, to be able to just recalibrate it to reflect Amazon. So those are all the things that, it's all those building blocks that I keep telling you about. Okay, so let's get started. So what are the deliverables? First thing is that read, the Pearson Rebel, the Robbins chapter 12, right? And again, you'll find that presentation. You don't have to read the entire chapter, but start with the presentation that's actually posted under the weekly comments, for topic 6, and you'll see it there. And again, these are the things that it covers. It talks about the nature and importance of control. And you got to understand, control is not, the carrot and stick. Control is to really see what's going on so that you can make an impact on where the business is going. And okay, I'll leave it at that. They're going to describe the control process and look at the types of controls that organizations use, and look at the contemporary issues in control. So this is a big part of, the keying in, what to study for the test, along with where you see the highlights, the golden keys, and some of the like the yellow highlights, and some of the bolded lettering that I put in here. Okay, no surveys to do for topic 6, so you're okay on that part. But let's talk about 6A. And it's due June the 4th, and if you take a look at this, we started looking at value, in topic 5, and now we're looking at performance right now, productivity. And if you want information about improving productivity, because you're going to have to answer some of these questions, here's a reference that you can use. But essentially what I'm doing is I'm giving you all the information here to be able to calculate productivity. So you're going back to your gingerbread a sale of $3 each, the ingredients that you did. And what you're going to do is you're going to calculate the cost of goods sold. And the cost of goods sold really gives you an idea of your profit margin, right? Which is sort of a general indication of profit. So that's why it's really important to that, because once you calculate your cost of goods sold, then you can calculate gross profit from that. And then I'd like you to comment on productivity of these gingerbread houses, how that can be improved, and provide me at least 3 recommendations. So this source right here might give you an idea, all right, of how to answer question number 3. Okay, so that's 6A. Now 6B is that we're going to get you to submit a team's balanced scorecard for your gingerbread activity. All right, and so what you need to do is you create the balanced scorecard. You got to understand what the KPIs are for that organization. So key performance indicators. So I'm going to talk about what KPIs are in this presentation, and then what is a reasonable production goal, and then how can you improve profitability, and then I'll show you, or you have to do an example of a completed balanced scorecard. Okay, so this is an example of and what it is that there's 4 categories in the balanced scorecard. There's finances, what you have to do for customers, what you have to do in internal processes, to be able to satisfy customers, and this learning and growth. It really explains what capacity is. What you're doing with learning and growth is you're building organizational capacity, right? And what you'll do then is that you will you'll pick some key goals, like for 2026 on what you're going to do. And you don't have to do this. You don't have to use all these examples, but use the examples that fit for, for the gingerbread house. And what you're doing at the end is you're calculating a mean performance. All right. So what it is like, and you'll see in the template that you download, when you look at finance, just in that finance category, right now, there's two elements that you have to learn, or two dimensions, right? Productivity and growth. And then productivity scores a 4 and growth scores a 5. And you take the average of those two to be 4.5. You can see here that in the customers, there's 1, 2, 3, 4 dimensions. So you add up your scores for those 4 dimensions, you divide by 4, and that's what gives you, the number for that. So, and I'd say 20% of the students who have done this before, they never do the average. And I wanted to kind of put this up front right there and then, right? So okay, so let's go finances. You want to measure productivity. And how do you measure productivity? Is you look at the revenue per employee and the operating margin. All right, so that's the key performance indicators that you use, and then you set a goal for that. So you want to increase that for the year to be 10%, and then you'll find out, oh, what's going on is that I only did 8%. All right, so 8 divided by 10, is 4. All right, that's the score. All right, so that's how that goes. Okay, so here's the actual template. If you click on this link, it'll come up, and then you just download it and use it. And already I've gone back again. You won't see this wording in this category, but you're going to see some explanation of saying, hey, it's the average score that I want. So here is going to be the average score of 2 if you select 2. And then this is going to be the average score of 4 if you select 4. All right, so that's where that is. Okay, so you got to say, well, what is control and why is control important? Well, what gets measured gets done. It's that simple, right? And so you're monitoring your activities, and what you're doing is you're comparing actual performance with the target, and you're seeing the variance of the where you thought you should be and what you're getting, and that gives you a sense of, oh, do I have to do something different? Do I have to lower my expectations, or do I have to put more resources in, those kind of things? And an effective control system, it allows you to have goal achievement. That's what it is. So it helps leaders plan, it helps it helps empower employees, and it protects the organization and the physical workplace. So you can see it protects. So you make sure that you're doing the right governance, that they're really linking to those 4 management functions we learned about in topic 1. Right? So those are the things that you're focusing on. So this is what what control and why control is important. So those are those 4 functions we talked about. So you start planning, you set your goals, your strategies, your plans, then you organize. Remember, I told you that form follows function. So you what are you going to do and why are you going to do it, and then you organize accordingly, and then you have a leading. So now you're executing on your goals and strategies, and that's where a lot of the frontline management sort of comes in, and you're really trying to manage individual and group behavior, and then you start measuring what's going on, and then if you're not up to speed, well then you reiterate, you recalibrate to be able to get to where you want to go. So that's why it's really self-important. So again, I keep on using this old phrase, but what gets measured gets done. It keeps you real focused. If you've got real measurement, like the most appropriate measurement that you could possibly use. And I've done a lot of measurement, when I was a process engineer. And what I found was if you made the measurement too hard, operations might start using it for a month and then they just stop using it because it's too frustrating. If you don't watch or look at the results and and actually comment on them and direct them, what'll happen is they say, hey, you know what, we're just doing this for fun. So they just stop doing it. So all those things that manage behavior as well. All right. And your critical measurements are called key performance indicators. So what you do is you're setting the goals, and then based on those goals, you want to measure the right performance. So you use KPIs, key performance indicators. And then what you do then is that, you put those key performance indicators in place, to be able to, put those into your process to be able to make that work for you. Okay. So what they are, they're a small number of agreed upon measurements that reflect your organizations for critical goals. And I'll tell you a story about GM back in the 70s. They had like 450 key performance indicators. And guess what happened? They couldn't get anything done. So they decided that they were going to narrow that down, and they got under 100. And that really helped things going, right? So they got to be measurable. They got to be objective. They got to be actionable. And we call those metrics, but those are key performance indicator metrics that they become strategic touchstones to be able to do that. So what are some of the examples? Well, the cost of service, and that measures overall value, right? What's it costing you to provide the service that you're doing, and how do you compare that against your customer satisfaction indicators? The percentage of technical support tickets closed within a specific time measures timeliness. All right, that's key. If your technical support's not meeting the needs of your customers, that's one way of finding out, and now you can do something about it. Percentage of satisfied users, measure user satisfaction, and that's where that goes. Okay, so what you need to do then is that there's 5 reasons why you need these KPIs. Understand how the operational decisions are made, identify the problems early to put actions into place. And I think we mentioned this, but there's leading indicators and there's lagging indicators. And a leading indicator is something that will give you an idea of what could be going wrong early on, so you could change something. And that's part of really managing properly, is having leading indicators. Lagging indicators, like, well, how much revenue did we make in a month? That's historical. And if you just had lagging indicators, it's like managing, through your rear view mirror on your automobile. So the leading will kind of give you an idea, and I'll talk about that a little bit as we go through. And then not only that, if you understand this in another organization, you're going to improve your own future job prospects, because it's results that counts, and what gets measured gets done is a way of getting results, and that's really going to help you in your career. Okay, so let's take this back to financials, right? So just to give you an idea of how financial KPIs pay attention to topic 6, all right? You notice that this is highlighted, right? So these must be really important, all right? So your cost of goods sold will give you an idea of your perfect pricing, so how much it costs. So you're going to price that thing so you don't go broke, right? So that you don't lose money every time you sell something. The gross profit, well, that gives you a good idea of the company's financial health and efficiency and how well they're using resources, because it's easier to calculate gross profit on the fly, and that way it gives you more of a leading indicator, like I said, to be able to make changes. Debt to equity, really important, especially if you've got a financial institution that feels that maybe you're not a great risk. Well, it gives you an idea of your financial stability and your risk profiles. I mean, it's no secret that banks will pull loans if they feel that a company going by the trending on their financials are going to go broke or go under. They'll pull their loan so that at least they can recover some of their investment. So that's what they're looking at. Okay, receivables to working capital. Well, understand what working capital is that's the money that you've got invested in the process. Like inventory. Inventory is working capital. You got to spend money to put inventory in a warehouse, right? And if you're not getting enough receivables, and gross profit to be able to manage that inventory, you go out of business. It's that simple. And then net sales to inventory, that really gives you an idea of, are you keeping the right amount of inventory in use? And if you aren't, if you've got too much, well then, you're expending your working capital, and that could be going to shareholders or profit, right directly to the bottom line. And then you look at economic value, and that's a measure of the benefit provided by a good or service. And then the working capital, like I said, the company operating and how financially stable it is. So that really gives you an idea. So these are the key areas that I want you to kind of understand. You don't have to be an accountant, but if you're certainly in a management position, you really need to understand, what these mean to your business outcomes. Okay. So where are we in the continuum of management principles? Well, now we're kind of hovering in the in the 1900s, where they started coming up with scientific ways, like measurement, to be able to know how the business is doing and how to get to efficiency and effectiveness. Okay. Here's another one. If you want to understand financials, if you click on this, BDC is especially if you're looking at starting your own business, I get on the BDC newsletter because they have all kinds of free training and information and frameworks for entrepreneurs that they could use. And this particular one, understanding financials, will put you in a good place in terms of really knowing what these are all about. So I want to do that. I'd want you to do that. Here's another one. Is that I put a video in here for understanding the balanced scorecard, and this gentleman does a really good job. I'm just going to see here in my sharing. I'm just going to go off to sharing. I want to make sure I'm sharing sound here, so I'll go off to sharing for a second. Okay, so I'm just going to play this and then just give you an idea of what this is all about. It's not working. Oh, here we go. Yeah, can you just give me an idea? Did you hear that sound? Did it come through? Yeah, just give me a thumbs up. Okay, or unmute or whatever. Yeah. Okay, good. And Brad, you have your hand up. Do you have a question? So just unmute and ask the question.
Yeah, I just wanted to know how to get the score for the balanced scorecard. What's the scale? I saw a lot of 4s there. So where's that coming from?
So wait, I still don't understand your question. So how do you get the scores? Oh, well, so no, you you make them up, all right? So that you can say that okay, I want to create 10 gingerbread houses a day, all right? That's the target. And then you say, oh, I only made 8 in the day, so that's that's the actual, and then you go from there, all right? Does that make sense?
Okay.
That's a great question.
So is that what you kind of expect from our?
Yeah, you got to use your imagination a little bit, all right?
Yeah.
Okay.
Okay.
So, okay. And did you hear the sound from this recording?
No, I didn't.
You didn't? Okay, I'm going to put it on again. Did you hear that?
Oh, I'm sorry. What does it sound like?
Yeah. How about you, Grant? Did you hear the video?
No, I'm not hearing anything.
Okay, let me just unshare and just make sure that this happened here again. Hang on.
Management teams to set and measure performance in a way that is aligned with the strategy of an organization.
Okay.
So why would you even want to use?
Okay, so this is a really good video, and it's just a quickie, right? It's I can't remember how many minutes now, but it's really well done and it'll really give you a good idea of what balanced scorecard is all about. Okay, so I'll just get rid of this now. Okay. Okay, so that's that piece. But essentially, what you're doing is, you're creating, your vision for that organization, and then you're developing, the strategy of what goes on, and then you can translate that strategy into a mission, as you go forward. And we're going to talk about setting goals. So here's how this all fits. This is the balanced scorecard right here. Financial, internal business processes, learning and growth, which I call organizational capacity, and customer. And what you do is you're going to set goals for each one of these categories, and then you're going to do a balanced scorecard strategy map where you can see that these are the 4 categories, and you may have 1 or 2 goals in each one of those, and you can see how these all connect. All right. And then it gives the organization leaders a view of how this really starts, and it all builds on each other. So this is the process here for the strategy map. Is what you're doing is, you're starting at the base here, learning and growth, and you're building internal capacity. Once you have internal capacity, then you can do the internal processes and the strategy. And then when you have to do that, then you start dealing with, satisfying the customer. And then what you'll see from the results is the financial. So that's how you do that. And this exercise will prepare you for assignment 4. And that's why it's so critical. Keep all your information, and what you're going to do is create a balanced scorecard and align this strategy for Amazon, and then create a strategic map for Amazon. And oh, by the way, you can go out and with AI and find out what Amazon strategy is, and get a lot of information that way to do that. Okay, so what does a balanced scorecard do? All right, so it's a really overview of performance. It aligns with the strategy, because look what's in the middle here is the strategy piece and the vision. It improves decision making. It helps you communicate across the board, with your employees all the way up to your board members, and then it allows you to do continuous improvement. So it's almost the best thing since sliced bread. All right, it's not perfect, but I don't think that there's any other vehicle out there that is as rigorous as this is. Okay, and what you do is you derive your goals from issues and problems, like opportunities. You don't brainstorm them. This is where, this is what's driving it, is how do you solve these problems to be successful? So that's where you set up goals. And I've been in organizations where, they just got in the room and said, oh, what do you want to do? Rather than saying, hey, what's our issues and what do we want to achieve from our vision? And now let's figure out what's going on, and we'll do a real SWOT analysis of the, like a situation analysis. And, and we're going to cover that in another topic as well. So what I did was I provide some examples of what goals could look like, in the learning and growth or organizational capacity, what goals could look like in internal business processes, what goals could look like, for satisfying the customer, and then what goals could look like to really know what's going on in the financial. So you would go through this, looking at your gingerbread example, and come up with a few goals, and to be able to put together for your balanced scorecard. And again, here's the link to get that downloaded, and then fill it up. And remember, this is the average of the different dimensions, right? So again, like processes here, if you happen to fill out 1, 2, 3, 4, 5, 6 dimensions, you'd add up the 6 dimension scores and then divide by 6 to give you the mean performance. Okay, so again, here's some steps. Understand your organization's vision and strategy. Develop these perspectives, or what we call dimensions. Select the performance indicators, and again, choose specific, measurable, achievable, relevant, time-bound. I think a lot of you have heard of SMART KPIs for each perspective. You set targets, and then you assign responsibilities. And so here's a video link, It's about 2 minutes. It'll help you understand what KPIs are. And then you put that balanced scorecard into motion. And then when you monitor and review and you create this actual strategy map, then you'll really kind of put that in play. So just a key about benchmarking. This also should be kind of in yellow. You should know what benchmarking is, but essentially what benchmarking is what you do is you want to improve your say your warehousing, to make sure that your warehousing, that products get to your stores on time. Well, what would you do? You'd look at Walmart and say, hey, you know what? They're leaders in inventory flow from warehousing. So let's ask them if we could go in and look at what they're doing and see if we can apply that in our business. That's what benchmarking is all about. So now we're going to talk about defining effective goals, and not necessarily strategic goals, but goals for the balanced scorecard. And what you're looking at is that here's the smart piece where you got to be very specific. You got to be able to measure it. It's got to be achievable. It's got to be relevant, and it's got to be time bound. So here's an example that I created to really give you an idea of what that looks like. So increase online sales revenue by 20% within the next 6 months through targeted digital marketing campaigns and improved user experience on the website. So you can see here the goal specific, increase online sales. It's measurable by 20%. So you're going to measure revenue. Achievable through marketing, and user experience improvements. That's user experience right here, UX. And then relevant, so support business growth, and time bound, we're going to do that within 6 months. Okay, so that's that's how that all looks like. So again, a little bit more about key performance indicators. Here's some examples. I've given you some already, but here's the key piece that I just I Googled this again today, and you have to pay for it. But I kept the file from way back, and I've got it on my Google Drive, so you can actually access that and save it. It's a really good piece, and Oracle uses this. Oracle's a big a framework type software company, and it really kind of give you an idea of what a KPI is and how to use it, right? Okay, so let's get back to 6A, and what you need to understand about cost of goods sold is that manufactured goods, cost of goods sold is different from just something that's resold, okay? Because manufacturer's good takes in also the cost of direct labor. And okay, so it's no secret that when you're building that gingerbread house, you have direct labor. So that's another thing that you have to put in. All right, and so that's the key distinction that you need to know. And here's more information on what direct costs are and what indirect overhead costs are. Okay, you notice there's nothing highlighted here, but it is in bolded letters here. So kind of know the difference between direct cost and indirect overhead costs. Okay, so again, this is highlighted, right? So this is a piece that you should know, and how to put this together. So cost of goods sold includes all the costs and expenses directly related to the production of goods. Okay, and then knowing the difference between manufacturing something and then just reselling, because hey, there's no labor in when in a retail store selling ladies' dresses. There's no labor in the retail store, right? It was all in the cost that of the actual dress, from the supplier. So that's to understand how that all works. So why does that matter? Well, it helps you calculate profit, right? Determines profit by subtracting the cost of goods sold from the actual price price revenue that you're putting out there to sell it. It helps you in pricing strategy, and then it helps you in financial analysis. So it's a really key piece. All right, so not asking you to be an accountant, but if you're running your own business and you don't understand the power of knowing what your cost of goods sold are, you're never going to be able to manage properly, right? Okay, and then financial health. So understanding financial health. So here's a little more about gross profit. Well, that's revenue minus cost of goods sold. Expense management, you're identifying and managing your production costs, and then you'll be able to budget much better. So the pitfalls, okay, sometimes it's a little bit misleading. So because you may have inaccurate gross profit figures, and you really truly find out what's going on, when you finally do the revenue statement on your financials, because now you've got everything in there, and you're really knowing what your true profit is. So gross profit could be a little bit more of an approximate number. So you got to be careful. If you're not making good decisions, wrong pricing, well, so that's what happens, if you ignore that. Okay, so understanding cost of goods sold is vital for effective financial management. That's the key one that you got to know. Just wanted you to understand too is that, okay, so you're let's say you're a restaurant making pizza, and you want to see, want to get an idea of, how about all those pizza business around you? How are they doing? Well, the government takes information about how they're doing, and you can go in and then get an idea, like the restaurant industry, the range, of cost of goods is 25 to 40%. All right, or the range of revenue to cost. All right, so you'll get an idea. Are you in the ballpark? So that's what benchmarking is all about. Is you're going in, you're tracking that, and another thing in the restaurant business, cost of goods sold plus labor costs should be less than 65% of your gross revenue. Otherwise, you're not going to make enough profit to be sustainable. So those are the kind of things that know what your margins are, and going in to be able to say, well, hang on, how come, how come my revenue to cost for liquor is 5%? I'm doing something wrong. I should be in the 10 to 20% a piece. So that's what cost of goods sold or benchmarking overall will do for you. Okay, and then there's another term called cost of goods sold percentage, and that's just that divided by sales. So that's a piece. And then gross profit, there's the formula for you. Gross profit is sales minus cost of goods sold. So sales is total revenue, right? And then gross profit margin is sales minus cost of goods sold over sales. All right, so it really gives you an idea of how in general profitable you are going through. So what is financial management? Okay, so you can see there's a little bit of yellow here. Well, understanding that it's all part of concern with profitability, expenses, cash, and credit. Okay, so just to know that piece as well. And then here's a whole pile of yellow here. So areas of financial management, understand what treasury management is, capital structure management, working capital management, and risk. Just know these definitions, to this level of detail. Okay, the profit planning process. So when you look at profit planning, the first thing you do, number one, right, is establish a profit goal. And I'm kind of giving you an idea here. Number one is there's kind of a test question in there that kind of covers that. So understand what the first thing you do, when you bring this together, and then you go through the other steps. All right, and then when you calculate profit, you may decide which ones you use based on your business and your business footprint and your industry. All right, to be able to keep track of, to make sure that you know what you should be looking at. Here's one about break-even analysis. I know I've got yellow here, but I don't think you're gonna have a calculation or anything. But what this is all about is that, if this is your fixed costs that is going up, because your volumes of sale is going up. Sorry, let's start again. Your fixed costs are this much right here. And then based on how much you produce, your cost of goods sold is going up. And it's no secret that if you increase your price, you're going to get to your break-even point, and profitability a lot sooner. All right. So it's all about, setting the price to be able to know, to stay in business, but yet, get to profitability as soon as you can. So as soon as you get, if you increase the price, you start getting profitable at this volume of sale. And then if you didn't increase the price, if it's a little less, well, then it's going to take you a lot more volumes of sale to get to, a point where you start making profit again. All right. So on this curve, this is your profit. On this curve, this is your profit. Okay. All right. Sales growth, so what did you do last year in sales? What did you do this year? You take the difference and you divide that by what you did last year, and it gives you your growth. Okay, so the challenge is, this is key, all right? If you're not growing your business, it's dying, it's declining, all right? And because costs are always going up, and that's what you have to, be aware of. That you need to grow your business to get your volume up to improve your overall margins, and you need to adjust your price accordingly. So there's not very many options. You can try to increase your revenues because you start making somewhat profit, so it'll bring in more. You decrease your costs, or you improve on your existing offerings that will give you more customers coming in the door, or you create additional offerings to be able to get more customers in the door. Okay. At the end of the day, though, the challenge for small business, cash flow, right? That's what the bank tracks, and if you don't have enough to pay your bills at the end of the month, you're in big trouble. Okay. So cash is king, right? That's, that's an old adage, that's out there. So understanding that will give you powerful insight to where your money's going, particular periods of time. Sometimes there's ebb and flows in the overall yearly cycle of a business. In some areas, you're not making any profit, but you got to make sure that you make hay while the sun shines, right? So on times when you make enough to carry you through. You're going to identify those peaks and valleys in your spending. You're unsure how to talk to your accountant, and the whole idea is to find an accountant that's a controller type accountant, not just an income tax accountant. And what controller accountants do is they really understand all this stuff, and they educate you. And when I had my business going, I ran a security business and a water treatment business in Calgary at one point in time. I had a controller type accountant, and that person gave me a heck of a lot of advice on how to manage my business, not only do my books and do my income tax. Okay, understand what a control cycle is. See that's highlighted here, and then in that control cycle, you've got planning, and then you got resource allocation, and then you got operating and monitoring, and evaluating and reporting. So understand what that is. You monitor those activities, ensure that they're being accomplished as planned, and correcting any significant deviations. So understand that control cycle. That's really key. So here's more information. You look at those I just said, but there's basic corrective action, and then there's immediate corrective action. So basic corrective action, you look at how and why performance deviated, and you do, this is more of a long-term fixing up the business to make sure that it's viable and more profitable. And sometimes on the immediate, you got to do something right away, all right? And you correct that problem so that you can get back on track, and you focus on the outcome. So know the difference, and you should be doing both. I mean, this should be a quarterly thing where you're looking at, hey, what can I do to improve my business? And this is, something came up. Oh, all right, we just didn't do enough lately. So what can we do? And then how can we deal with that on a long-term basis, once we're over the hump? Okay, so again, here's something key. You can see that it's highlighted. and what do you do then is that, you set goals, all right? And then you set up those standards. And again, you're benchmarking the industry standard or a competitor, seeing what they're doing to make sure that, you're going to be as good or better than what they are. And then once that standard is set, then you start comparing your business against that standard. And is it being attained? Well, you don't have to do anything. If you're not meeting that standard, well, is that variance in that standard, is it acceptable? Sometimes, well, it's not as good as competitor A, but I'm still making money. So, hey, it's okay. So I won't do anything. But if it's not acceptable, again here, well, then you revise that standard and or you do something about it, right? And go from there. So this really kind of gives you, and if you can identify what's causing that problem, then you fix it. All right. So this is your course of action here. So understand that piece. Okay. When does control take place? Well, okay. So there's input. And when you're putting in your raw materials, whatever, it's going through your process or it's your output. Okay, so you can see that there's a key here. So when the input, you can see feed forward controlled, that's where I talked about lead indicators, right? So you have indications that will give you an idea. So here's a typical example, all right? So your sales organization, and you want to make 10,000 sales a month, right? But before that, you need to generate leads, right? Now, if you're only generating 5,000 leads a month, you're never going to make 10,000 sales, right? So the number of leads is a leading indicator, and so that that, hey, I got to do more in terms of finding more leads to be able, because there's a ratio of leads to conversions to sales kind of things. All right, so that's where feed forward control comes into. But in the processes, you have concurrent control, and what concurrent control means is that there's certain things that are going on at the same time in that process, in that concurrent control. So, and you correct those problems as they happen, right? And that means is you might have a machine that's not working as well. You fix it right away, and that will improve everything else, your output. But then at the end, which is more of a rear view mirror type management, you have feedback. So you have trends. Well, how many widgets did I make in a month? How many widgets did I make in the last 3 months? What was the quality of that? That's all. That's all side of kind of historical information. And if you get into concurrent control, while it's running and fixing it up, see that key. Well, then you can avoid that. And not only that, when you do it at this level, it costs you less to do. All right, it costs a lot less. So you can see that if you can get it right from the start, it's not that much money. But if it's at the end, then you've got major redesign and everything else to worry about. So that's how that works. Okay, traditional financial controls. There's ratio analysis, budget analysis, and then you should know what economic value added is. And here's the formula: is that it's operating profit minus the tax minus the annual cost of capital, like the interest piece, and that's what will give you, are you adding value to that business, all right? And then there's market value added. I just I just let somebody in here. Okay, so if you look at market value added, what that is that's your common stock plus your liabilities, and you say plus because these liabilities really are negative, right? Minus cash, minus initial capital investment. And this is the stock market's estimate of the ability to increase shareholder value. So those stock analysis are really looking at market value added to be able to raise the price of your stock or whatever. Okay, so financial ratio analysis. So what do? They provide insights into how well a company is performing. And the thing is that it kind of splits in two pieces. And this is more for your information, but half of it is looking at performance ratios, and the other half is looking at your financial leverage ratios. And really, the banks or the financial institutions really kind of track this, because this is a good indicator of of your sustainability of your business. This one here is that, hey, this is how well you're doing right now. Okay, so those are key. So understand these definitions. What's liquidity? And what's solvency? Solvency is, hey, I can meet my long-term debts. But liquidity is, hey, I've got enough money to pay short-term bills and debts, and I can sell assets really quick. Liquidity means, hey, I can make this work real fast. It's liquid, right? This one here is that some of the investments, it takes a long time. Like, you couldn't sell a part of your business in time sometimes to save the rest of your company. Here's a thing on financial ratios. It's more for information, but it'll give you an idea of what's out there. And again, I keep on going back to what key financial ratios that you track are inherent to what kind of business you're running, how you want to run that business in terms of what your vision and mission is, what your competitors are doing, what the industry is doing, and what's going on in your footprint area as well. All right, and that really kind of determines what are those key measures, to be able to keep you successful. Okay. We talked about that quite a bit, but this is, this isn't too important to understand, other than, you're not going to have to know all these by heart or anything like that. So don't worry about that. So just a little bit more about benchmarking. The best way to understand how well your organization is doing, where and how it could perform better. So you always kind of compare yourself to, your key competitors, because you can go into their annual reports and find out how they're doing, or find other ways to look at or get a sense of how they're doing, and then work to that, and then look at government information about the industry. So there's many ways to benchmark. So here's the key stuff. It's all kinds of benefits. Connect best practices to strategies and goals. Identify best practice throughout the organization. All that. So this is really key to understand. And then you can benchmark some of your KPIs across your balanced scorecard. That's key to know what's going on. And then so here's where those targets come in terms of benchmarking those key dimensions of your BSC categories. All right. Again, you set some goals for 2026. A little bit about corporate risk management. Well, what are you doing? You're protecting your assets. You're ensuring, in some cases, the bank will want you to have some kind of insurance for whatever they're supporting in terms of the loan that they're giving you. You're looking at mitigating financial risk. How can you get around that? And then enhancing your decision making. And then it all comes back into, your investors may be more confident if they know you're really managing your corporate risk better, maintaining business continuity. Sometimes it's all about having that second control center somewhere, just in case, your first one has a fire or whatever, and then fostering a risk-aware culture. So that's key. So in essence, corporate risk management is about preparing for the unexpected. That's what to know. So here's what's highlighted. So type of risks. So speculative and market risks. So it's the uncertainty and a voluntary taken action will result. And the thing is that you don't want to bet the farm on certain things. So that's being speculative. And then there's pure risk, uncertainty associated with a situation where only loss or no loss can occur. Here it's sort of like it depends, right? And this is a lot more risky, than just knowing, exactly, where you can sit. So in terms of property risk and liability risk and personnel risk, so you really want to, put that down. Okay, so what's the process? Well, you've got to identify and understand risks. You've got to evaluate potential severity of risk, select methods to manage that risk, implement the decisions, and review and evaluate. So when I first got into corporate management, there was, an audit department, and they were responsible for risk, all of risk. And now risk is so rampant. It's, because of all the uncertainties around terrorism, around, like this, oil situations, right now going on with Iran, those kind of things, that the corporations decided, hey, everybody's got to worry about risk. So in every department, they'd have to, the organizations or functions would have to identify their own sets of risks and really get a sense of how they would manage those risks. And then audit now just collects all that and make sure that everybody's, risk management is everybody's responsibility. So here's some strategies. You can avoid it. Choose not to engage in risky activities, right? So let's look at this organization that sells event stuff. Well, they'll decide, hey, you know what? We're not going to sell fireworks anymore. It's just too risky to, our warehousing, protection and stuff. So that's how you'd avoid it. Mitigate is that, oh, hang on, maybe what we'll do is we'll build a separate building for fireworks, and we'll get insurance. And then what happens is, and then what we'll do is we'll have better fire control. We'll have better, checking. We'll have better instruments to know and procedures to manage that. So that's how you mitigate, lessen the risk going through. And then the transfer is, you know what? We're just going to get insurance over that, and then someone else will cover the cost of that loss. And then assumption, financial loss internally. So here's one: is that I don't have a rock windshield protection on my insurance. I'm assuming the risk myself. Okay, so that's what that's all about. Okay, so how do I identify strategic risks? Well, you continuously look at the external and the internal environments. You got to be looking outside and seeing what's going on, and looking inside to see what's going on. And then you start the discussions, and then you gather information. Okay, this is only information only. Okay, so I'm not going to go through this stuff. I'm going to leave it for you. But here's a good piece on an example of how to do a balanced scorecard strategy map, and you can see how all these connect, right, to each other, to be able to, get to the financial strategic goals. So this is a really good example to use when you're going to put yours together. Okay, so that's the end of topic 6. Any questions? And what I'd like to do is I'm going to just shut the camera off and the sound, and so that those of you who are just watching the video, they'll know that there's going to be a brief stoppage, and then topic 7 will continue in the next 10 minutes. Okay, so any questions at all? Okay, since there's no questions, then I'm just going to shut my camera, shut the sound, and I will be back at, it's 2:02 right now, so I'll be back at 2:10. Okay, and we'll take it from there on topic 7. Topic 7, I don't think is as rigorous as topic 6, so, and it'll probably be even a little shorter, but it's good to understand what you need to go through for your participation activities and what's coming. Okay, especially I'm going to cover a little bit on the assignment number 3 as well. Okay, so here I go. I'm going to shut the camera and shut the mic. Okay, I'm back. Any questions at all before I get started? Okay, so I'll get through. So this topic here, 7, is how to manage human resources. But here's where a lot of the theorists come in. And so I'm pointing towards test number 2. Okay, so that's where that comes in. You're going to see a lot of highlighting around some of those theorists. And I know that you've been looking at these theorists already for your assignment number 2. So a lot of you are becoming familiar with that. And I'll take you back to, that one presentation, that appendix presentation where I covered all those theorists, and be good to review that for test number 2 as well. Okay. All right. So we'll get started. So the deliverables for topic 7, you can, just before we get to that, I'll just talk about AI assistants, all right? So yesterday, that's when, when I was around and Google came out, that was the only assistant you had, and then you could research stuff, and it was very novel back then, and you had to learn how to use it, and it was a big deal. But now we're into artificial intelligence, and look where it's going. I mean, it won't be long before everyone has some sort of an AI coworker. And, it might not be a robot, but it'll be, it'll be some assistant that will allow you, do part of your work for you. And you're just going to be able to tell it what to do based on some of the specs that you input into it. And it's get ready for it. Just strap in. It's going to be a heck of a ride. Okay, so again, I made that announcement about assignment number 3. You can find that and you upload to Blackboard topic 10 in Blackboard topic 10, and it's due the 29th. And I really encourage you to look at the helpful video and take heed to the instructions on how to do that. And I know I'm asking you, and I reemphasize the fact is, please follow the numerical and alpha numbering system and use headings and subheadings. Help me help you, all right? And the easier it is for me to figure out what's going on, the easier it is for me to evaluate that you've done your due diligence and you deserve a good mark, all right? So that's how that's going. And as well, I prepared this associated PowerPoint presentation where when you go through that video, you can actually go through this PowerPoint and access the slides that I've used and understand what's going on. Okay, so a little bit about test number 2. So now the practice test will be in topic 8. And again, it's this side of the arrows that are most important. So these Robbins chapters, PowerPoint presentations are key to really kind of elaborating on the highlighting and the golden keys and the bolding that I've done, because it really rounds out those pieces, and it will really give you a good background. And the thing is too is that you can you can get a lot of the commentaries, but review the participation activities as well, because some of the things in there are in the tests, and it'll give you some better understanding. And again, the test is going to be remote. It's going to be over a period of time. It starts on June the 5th, ends late night on June the 8th, and then there's always these Blackboard topic slides in the deck that the slide decks in Blackboard you can go through, and a lot of the videos are very helpful. Dr. Powers was really good at getting down into the details in those video presentations. So I strongly recommend that. Okay. All right. So again, we talk about that the register set the time for the final exam, or test number 3. It is. All right, it'll be at 7 p.m. And on June the 19th. And it's one time only, one day only. And the thing is, it's so close to admitting the remainder of the marks that I don't have time to be able to accommodate at that point in time. Okay. So again, you can see where all the things are due. And this comes right out of your course outline. except for a revision I did on this piece here. Okay. All right. So for topic 7, the environmental constraints of managers, this chapter 2 is really important. This Robbins presentation will kind of really give you a breakdown, and it's just partially related to test 2. So the slides 17 to 30 in that presentation are mainly to test 3. So just that you know that. Okay. And assignment 3 takes you to a new layer of specifying goals. I think I've gone a little bit over in terms of trying to get you to understand how important setting goals are in the organization. And it's mainly not for the person who assigns the goal, it's for the people who execute on the goal. And if it's not clearly mapped out, then that's where things break down. All right. You can have a perfect plan with a perfect situation, but if the goals really don't really depict what needs to be done in the execution, things go sideways. All right, so that's what that's what you need to keep in mind, and it'll save you a lot of grief. It'll save you a lot of explanations if you do it right. Inside of the goal itself. Okay, so I've created these goal creation guidelines. Why am I so crazy about this? It's because, I've done, up there in the hundreds of business plans with people. And I've found that, hey, this is where the rubber hits the road, okay? So the phrasing of the strategic goal, the words are formulated towards achieving, a desired future outcome. What, by when, outcome end date. And you got to put that date in there, like December 31st. You got to put that in there because it adds urgency. And urgency is a big factor in getting things done, psychologically. And it's been proven in the research, right? But the goal is a clear and compelling statement that all members, mainly employees, benefit from a clear line of sight. They know exactly what they have to do, right, in satisfying that goal. So you use clear goals to unify your team, your leadership, your counterparts. And so I've given you an example. So here, increase awareness and support for our local, national, worldwide member programs by December 31st, 2025. Okay, so we will increase awareness and support of our local, national programs from 40% members to 75. You see how we put the target in there, and by the date, right, as measured. So what are the KPIs? What are the metric KPIs that are really important as measured by our annual awareness survey? Members are our business lifeline. How we as individuals connect with them and serve them is how we maintain. So here, you've done a little bit of context on that goal. So it really kind of gives people a really great idea of what you're doing. So what you need to do is you have a title for that goal. I know it's done in strategic goals here, but you have a title. And why? That's because you can organize your goals. And then when you're talking about them, you don't have to talk about the full portion of the goal. You've got a little title for it. So you can say, okay, goal 1 on enhanced customer satisfaction. That everybody knows what goal that is. And then you make the statement in that goal, increase overall customer satisfaction and retention rates by improving service quality, responsiveness by a certain date. And then you give the rationale. Okay, this is why it's important. This is why it matters. I keep on getting back to why it matters. And then every goal is a higher power achievement. And so that the more that you can chunk that goal, break it down, the more the more people get a sense that, hey, it's achievable, right? And hey, I could do this. If you have a goal that's just too much of a stretch, people don't know how to handle it. All right. So what you do then is you break it into, some really main components, in your objectives. And then you provide that timeline for that. And then what are the key performance indicators or the metrics that will be able to give you a sense that, hey, I'm making progress and I'm reaching my actual target, and I can do something about it if it doesn't happen. Okay, so it's all about stating a goal for the person in charge of the goal's execution. The people are doing it such that it's understood long after you created it. That's the key thing about setting goals. Again, chapter 9, have a look at that. It's called Managing Innovation and Change. That's key. So what deliverables do you have? Well, you got all these surveys to do, by June 5th, in Rebel survey. And then as a group exercise in 7A, I want you to submit at least 5 ideas in tabular form with a short sentence on why you chose each idea. So ideas for motivating employees in a large international business, identify those. But what you're doing here, critical thinking, why it matters. All right, that's really what you should always have the why. And something that if you ever heard of Simon Sinek, he talks the power of why, and people really will follow you because they know why they're following you, and that's the real key, to motivating people as well. And then ideas for motivating employees in a family business. All right, so you put those down. Then why? All right, why it matters. Short reason for the group's chose that idea, and refer to the theorists and the management theory applications. Refer to the theorists and management applications, and that way that will click in, so that you'll be somewhere someday and say, "Oh, I got an efficiency problem. Oh, who could that be?" And then the right theorist will pop into mind. All right. Okay. The second one is that now we're getting into the HR piece. So what I want you to do is virtually, replicate this template. All right. It doesn't have to be in color, but with one column in terms of what you're doing, and then the fulfillment of what you've been asked to do. So it's really to help with a job description, and what all these things do then really covers it really covers how to recruit, right? And why you're selecting a key person, because they have all the information, and it provides you a lot of context for setting up the job. And I'll tell you something else too, is that a lot of HR organizations, they put everything into recruitment, but they never check back, like 6 months and 10 months or a year, to be able to see how that person's been doing, and did they really satisfy the criteria of the recruitment that was put in place, and they never get a chance to change what they're doing if they don't do that, right? Okay, so that's the first part, and the next part is to develop a list of interview questions, no more than 1 page. And this participation activity provides you the insights on how to address, the related deliverables in the Amazon group project assignment as well, right? So you're working on your Amazon assignment here as well. And check out slide 60 in this presentation on why we're doing this in terms of recruitment. And that's, I was talking about that. It's called the reliability in the selection process. You go back and you tie that back, to later job performance to see, did we set up the right criteria? And is this working, and how can we change that and better recruit the right people for the right job? All right. So again, here it is, the job description, it's a written statement of what a job holder does, how the job is done, why the job is done. Why? Again, job specification, minimum qualifications that a person has to do. We talked about this reliability and the validity in terms of the selection device is tied to a later job performance, and the selection device measures the same thing, so that, when you're setting these up for a particular job, you're measuring the same success components that will make recruitment a success in your organization based on your vision and your corporate culture. Okay, so here we are in the scheme of things in terms of, that continuum of management principles. We're into the behavioral and the quantitative here, okay? So that's where you're going to see these theories pop up in this area, okay? Now let me just go back to assignment number 3, and I've asked you to do a problem statement. And there are good problems, those are opportunities. And there's bad problems, those are threats to address in planning. So a problem is not just necessarily something bad, it's an opportunity as well, just so you know that. But significant problems can't be solved at the same level of thinking in which we created them. That's what Albert Einstein said. And he said, if I had an hour to solve a problem, I'd spend the first 55 minutes determining the proper question to ask for once, So defining the problem properly is 90% of the solution, because it really sets the scope for the solution. If the problem's too vague, it could be anything, right? And back in my day, it was Kepner-Trigo that had a problem-solving solution. And what they talked about is it's the problem as understood, and it's what the problem isn't, right? So what isn't is as important as what is, and that really defines the scope of what the problem is to be able to solve. Okay, so effectively characterizing a problem is crucial because it ensures a clear understanding of the issue, guiding the development of appropriate and targeted solution options. Okay, so 90% of the solution can be found by clearly defining the problem statement. And here's a link. I don't know if this link is I didn't test this one today, but in your assignment instructions for assignment 3, there's a link to creating the problem statement. And it's short, it's clear, and it issues or it's a challenge or an opportunity or threat. And the best time to create a problem statement is before you start thinking of solutions. Don't even go there, because then you're going to get into what? Biases, right? So really define that problem and use the right people, get the right people around the table to make sure that you've got enough diversity to really characterize that as a problem that's truly understood in the organization. Okay, so there's all kinds of problem solving areas out there. This is just for your information, but the McKinsey problem solving framework, root cause, Six Sigma, EI approach to problem framing. But what I found is pick one, study it, use it, and then go with it, right? And that way it will always come to mind, and you'll have the fundamentals of the approach to be able to go through and solving that problem. So it'll come, second nature to you, rather than, trying to analyze, a new problem solving framework and then getting caught in, just trying to analyze that without actually, really focusing on your problem. So I wanted to give you an idea of, how this, kind of enters into the planning process. So a lot of times, you start with an environmental scan, and what you're doing is you're identifying trends and you're identifying opportunities and threats. All right. And then what it is that you will do, a SWOT analysis, and then that scan will be converted, into, a strategic issue. And an issue is, well, it's a good problem or a bad problem, and it's important to us because we've ranked it, and it has a great impact on our organization. So now, we're gonna convert that into goals, objectives, initiatives, and action plans. So that's how you get to, that strategic, from a problem to strategic issue to where it goes. So that's how this all kind of comes together. But this slide is a test question in itself. All right. So just so you know, you got to know this one. All right. So defining performance, you can have all the ability that you have to solve that problem, but if your workforce is not motivated to solve that problem, it won't happen. All right. So just understand this formula. Performance is ability times motivation. Right. And when we say times motivation, it means that you have the right behaviors, it will really make the difference, using the abilities that those people have. All right. And again, another formula for you know, the learning organization. So performance equals ability times motivation. Okay, so this was just a group thing that we were going to do in real live classrooms. So you're not gonna be able to do that. But something you should understand, though, I'll give you a little bit idea of, you know, why do we get into HR and why do we get into you know, management principles around managing behavior and those kind of things. Well, the most important thing around, you know, workers is that, first of all, they they trust their line manager the most in the entire organization, right? And employees, they leave their boss, not their organization. And I'm an example of that. I mean, I left a real good job in one part of my career because I just couldn't work with that boss. And why? Because that boss wasn't fair in terms of and you know, forthright in terms of how to actualize the vision of the company. And I just left and I went somewhere else. And the thing is that managers account for at least 70% of the variance in employee engagement. So if your manager doesn't understand how to motivate, how to change their management style to accommodate, you know, certain types of employees, you know, in the history of their work, you know, because you know, so employees in some cases they come in with no experience. Well, you got to manage them differently than if you have an employee that comes in with a lot of experience. So those are the kind of things that, you know, you really need to understand, and you know, that's what, you know, some of the theorists are covering in situational analysis, right? So management matters, but leadership matters more. Okay, and I always thought that, okay, the low-level manager, they have to manage, and the high-level manager, well, they have to lead. Well, you know, it comes together now, and leadership really matters. And leaders have a much stronger effect on employee commitment levels. There's no doubt about it. Okay, so look at this: great managers, okay, they're great leaders. You know, 89%. You know, leaders have a much stronger effect on employee commitment. And then the thing is that the impact of good management controlling, you can see that above average development opportunities, you know, they center where above average manager ratings are, and look where that goes. Okay, so whole bunch of keys. So you got to understand this this piece. Behavioral view of management. Motivation is the process by which a person's efforts are energized, directed, sustained towards attaining goals. All right. And there's three elements: the energy, the direction, and the persistence. A really key slide to get an understanding of persistence, sustained effort to achieve a goal and satisfy a need. You know, those, you know, that's really what you want in employees. That's why you know, you need to tell them, they need to know what direction they're going in. They need to know where they're going. And if they don't know where they're going, they'll find a direction on their own. And then, you know, they need to have the energy, a measure of intensity or drive. So that's key. So you can see how this breaks down. You know, we've got some content theories, you know, where, you know, Maslow and Hertzberg and McClellan, you know, they were looking on, you know, the human side and how to, you know, how to focus on motivation. And then you got the process theories, you know, the you know, in terms of, you know, what makes things work, you know. So look at Taylor's motivation theory, but mainly around efficiency and effectiveness. So Mary Parker Follett is a good theorist to really understand, you know, what's going on in terms of new ways of managing, and she coined that term, win-win. And look at it, it's highlighted. So you got to know that. All right. And remember the famous FM radio station, WIIFM, you know, what's in it for me? And I used to use this all the time in my management groups, saying, hey, you know, if we really want to, you know, people to follow us, we really want them to be motivated, they got to know what's in it for them. All right. So I talk about that famous FM station, WIIFM. Okay. Donald F. Roy, well, you know, he focused on motivation and self-actualization, how workers experience time. and if you can get workers to self-actualize, it means that, hey, they're just delighted to do, great things because it makes them feel, all good about the world and themselves, all right? And you can understand too is that these are all connected. Like theorists build on other work. And Donald F. Roy, it's no surprise that when he looked at this piece, he was really looking into Maslow's hierarchy of needs, right? And this is a key one that everyone should really understand. And I'll quickly go through maybe a slide of my own experience using Maslow's theory, if we have time at the end, okay? But understand, what Donald F. Roy was all about, and then what is, Banachine was all about. And it's all about people still have to have fun, all right? So each morning, when a banana would be stolen from a worker's lunchbox, they'd have a little bit of a break and some fun, and so the work was made tolerable, even though it was in his areas of research. They were hard working areas to work in, and so they make it more tolerable by creating the relationship with coworkers, where they're all part of. If you take a look at the fire service, I mean, they're a community of brothers. They have each other's back. It's right in their culture, and that's what makes them so effective in doing doing their work. It's all, they've got everybody's back, and they know what they have to do, and they've got great intentions on helping people, right? So that's what that's all about. So I got you a little more explanation on what Banana Time really was about, so you could read that in your spare time. David McClellan, key psychologist at Harvard, but regardless of gender, culture, or age, people are motivated by 3 factors. So let's talk about those 3 factors, all right? The need of achievement, the need of power, and the need of affiliation, all right? So if I look at myself, I was big, and I still am, in the need of achievement and the need of affiliation, not so much in power. As long as I get things done, I'm okay with that. But really understand the characteristics of this person. So with power, they want to control and influence others. They like to win arguments. They want to enjoy competition and winning. So knowing, what these needs are, and given the people that you have to manage, well, then, you will treat them differently based on, their particular needs. Maslow, this guy is everywhere in terms of management principles and inside of, the fundamentals for management culture all over the place. I've seen this just about everywhere I worked. This was just a given around that, so, you start at the base, that if you're not looking after people's physiological needs and safety needs, they're not going to do anything great for you. And as you bring them up that hierarchy, they'll be more and more self-motivated, to the point where, this is Gandhi right here, self-actualizing, desire to become the most that one can be. Victor Vroom, another really important figure, because Victor Vroom, created expectancy theory, and people will respond to the expectations you place on them. They're based on the expectations that the action will be followed by a given outcome, on the attractiveness of that outcome in an individual, a key definition to know. And you can see where, a person will do individual effort. Well, they will, if they're recognized, then, they will move on to better performance. And if the performance is recognized, and rewarded, then they will go on to, organizational rewards. So understand that employees can see themselves as a shared vision, at this point in time, when this valence is intrinsic appeal. If you can have your employees see themselves in that vision, and it's part of their vision, then you're on your way to success, as far as I'm concerned. Okay, so improving expectancy, make sure employees have the necessary skills for the task, right? So you're giving them the skills. Improving instrumentality, well, observe and recognize the performance, deliver rewards, and then improving their valence. ask employees what rewards they value, give rewards that are valued. So this is a key thing to understand. Douglas McGregor, a lot of you will use that in your second assignment, and this is kind of a staple in the in HR. Understanding theory X versus theory Y. So you should go through that. And then Frederick Winslow Taylor, key guy, U.S. mechanical engineer, father of the scientific management. And the thing is too is that I know that it's sort of cut and dry what he's doing, but his theories and management principles still work today in certain situations. So don't discount that, saying that it's all old-fashioned, because you still need efficiency and effectiveness, and especially in the organizations that are high risk in terms of life or property loss. Frederick Winslow principles apply, like the fire service or the police service or those kind of things. So it's not it's not outdated. Okay. So efficiency improved through experimentation with methods of work and production. Lawrence and Naria just understand that they are more about how human nature shapes our choices. But here's one of the key things that you can see some golden keys going on here. So what drives people? The drive to acquire, take control and retain objects and experiences, the drive to bond, form social relationships, drive to learn, satisfy curiosity, drive to defend. But if you take a look at, let's go back here. McClellan's, Abraham Maslow, and now these guys, there's a lot of common links in here, in terms of principles for management, right? And just kind of understand this piece, so, drive to learn, well, it's a motivator, and, those are, and there's environmental factors related to that, and personal factors. So that's where that goes. Okay. Here's a piece around culture attributes to enable motivation. Right, so those are those pieces. So a little more to read on that. Hertzberg, right? Factors that motivate workers are different from the factors that demotivate people. That's key. So let's look at this. These hygiene factors. All right, this is what we call in poker table stakes. You got to have these things. All right, and if you don't have that, you're nowhere seen to have it done. So the important observation Hertzberg make is that hygiene factors can cause people to leave, but they cannot make people motivated, right? So this is if you don't have these, they're just gone. But if you have these plus these, then all of a sudden now you can really affect the motivation process, in terms of in those areas of motivation. Okay, so again, this is a placeholder for 7B activity. So you should understand this piece to do participation activity 7B, and the way tasks are combined to form complete jobs. So skill variety, task identity, task significance, autonomy, feedback, and you go through all of that in terms of the nature of the job versus the nature of the person put in that job. And you've got a good combination. Okay. Recruitment and retention, that's what it's all about in HR centers. It's one thing to recruit, but guess what? If you lose an employee, it's roughly around 6 times the annual salary to recruit the replacement, especially in more sophisticated jobs. So the management function concerned with getting, training, motivating, and keeping competent employees involves both of them, all right? And so understand that. So you can see a whole pile of keys in here. So understand how this whole piece works. Open book management, you see the impact of their decision on financial results and of organizations. So a guy by the name of Jack Stack, he wrote a book about, I think it was International Harvester. And what it was is that the company was going broke, and they were just going to sell it off, and the employees bought it. All right. And what they had was every employee was an owner. And what they had was they shared the financial results from month to month. So everybody could see the impact of what they were doing, right down to, the janitor and the, people doing the security for the operation. And that had a tremendous impact, and that they pulled that company out of the fire, right? So there's a big incentive, there's a big advantage to doing open book management. The more that you can share, with your employees on where that organization is going, and they feel part of that organization, the more they will be motivated, to perform. Okay, so this is just one, right? It's highlighted of recognition reward program. Programs, personal attention from management, pay for performance, gamification. You offer prizes, professional development, training opportunities, work-life balance. And I'll tell you, so I had a team of 60 people that we pulled off of various areas of Alberta to improve the service delivery process for TELUS, right? And one of the things we did was we had an employee forum, and we wanted to report on all the progress these people made. And what we did was we bought them all these really neat blue T-shirts, and then it had the actual process improvement team, blah, blah, blah on them. And they were all up in one area of the assembly room. And that did more for us in terms of motivating those employees. They really felt like they were part of something really special, right? And that was one of my career highlights that I experienced. Anyways, here's this thing about Jack Stack. If you're interested, it was International Harvester, and so you can see that it made a big thing. And then we get back to that piece around recruitment. Understanding the selection process. The reliability selection device measures the same thing, in terms of recruiting. You're not going to, and that way, you've got standards to be able to measure by, and then looking at, the gap between, where the performance should be and what the job was meant to perform, and where it should be, and what that employee is doing based on the recruitment criteria that selected that. And then you get an idea, hey, do we have to fix something here? I'm not going to talk about that. You should understand, that there's a difference between direct compensation or salary and retirement, but indirect, work-life balance, recognition, professional development. I'll just give you an example of indirect compensation. So I was on the board of the credit union for about 10 years. And the average work time of a service person at the desk, like collecting money and stuff, was I think it was 6 months. They come in, they'd work, 6 months later they were gone. We wanted to do something about that, so we started looking about what can we change to be able to make that job more rewarding for them. And one of the key things was in terms of time off, for their children, taking them to school or whatever, and making their schedule more flexible. And guess what? Within 2 years, that went from 6 months to 18 months. So we, the retention time. So there's things in indirect compensation that can make that can really make a big difference. Okay. So again, recruitment and retention, which is key, and identifying the gaps in human resources inventory list of employees with education, training, and language. So here's another example. So being on all these boards, I was charged one time to actually do a board member portfolio of what kind of skills and education capabilities that each board member had. And then we put that against where did we want to take the organization in terms of vision, and what kind of skills, capabilities, talents that we needed to fulfill that newer vision. Well, we started recruiting the right kind of board members to be able to satisfy those deficiencies. And got big improvements. Okay, so that's how that works. You should know, a little bit about workforce reduction. And that's, either a position is eliminated with no intention of replacing it, results in a permanent cut or headcount. An employer may decide to reduce its workforce by terminating employees or means. So there's different ways, all right, of workforce reduction. And this one's key. You can see it's highlighted. Natural attrition. So once a staff member leaves, well, then they might redesign and not replace that, and it'll get picked up. But there's other things like a hiring freeze for a while, and that's to control costs, reskilling, limiting overtime, layoffs, reduced work weeks. So there's all kinds of workforce reduction strategies there. But this one here, in companies that are really, it's really important that they maintain their workforce, and keep them fulfilled. Is really, that's how they kind of work, is through natural attrition. Yeah, and here's something else too, right? So when I first went on for TELUS, a year later, the AGT, the telephone company, was the subsidiary of TELUS. They laid off. No, they didn't lay off. They retired like 2,000 people, right? And they just cut the force down. All right, so that was packaged out kind of thing. And the big problem is that the people who were left, you don't realize how much what we call corporate memory, what's inside those people's heads that's not on paper or in a procedure that they use to make the company work, left the company with those 2,000 people, right? And it was much harder for the people that are remaining to be able to make that business work until they made adjustments and started working total quality management to be able to fill up some of those white spaces, right? So those are the kind of things that you need to think about. Just to understand, Elton Mayo, about Elton Mayo, because he's a really important guy, the Hawthorne effect, and really what that was all about is that they were trying to find ways to improve productivity. Less lighting, they changed the lighting, whatever, and they were seeing differences. But they didn't really understand it wasn't the changes that we're making. It was the fact that they were paying attention to the employees, right? So that was a lesson in itself, is that, if you want to engage people, you've got to be interested in them, and you've got to engage with them and those kind of things. All right. So that's what that's all about. So you can see there's a key here to understand what Mayo did, and that lack of attention in workers results in underproduction. I mean, that was the big Hawthorne effect discovery. All right. So again, more things to know about that. Okay, here's where we're getting into. This course does not talk about core values, and I think that's one key thing to really understand, and why, because my personal experience got me there, is that I really didn't understand really the true core values that I had, and I didn't understand the priority of the values. And the priority of the values is that you will have a particular behavior that undercuts another lesser important value, and you don't even know that you're doing it, right? And that's the key thing. So if you know what the hierarchy of your core values are, you will have a better idea of how you make decisions in life, in business, in everything. All right. So that plays a big part then in values-based recruitment, because if you've got a strong culture in your organization and you want people to come in to fit, you really need to take a look at their values, and here's where like Maslow's hierarchy of needs come in, because this is all about core values at different levels, and understand where they are on this hierarchy to know if they're going to fit in your organization. Okay, we talked about that, but the things, you make decisions through the lens of your core values. So they set our standards for what we would or would not be prepared to do, and that's really key. So just a little quick one is that I was involved at TELUS we surveyed 1,200 employees, and we wanted to see where they fit in terms of values. All right, and then given that where the majority of the people were on this value scheme, then we would change our policies to accommodate them better and hopefully get a lot more motivational devices to drive better performance. Okay, and what I didn't realize is that if you turn this chart by 90 degrees, you get this. All right, I didn't know that. This is a self-actualization up here, and what happened was when we did survey that, we saw that the majority of the people were in this self-initiating piece. So we started changing the policies and procedures to mainly accommodate that. But one thing that I did learn, if something happens like layoffs or the economy falls or the company loses a bid, these values are mobile, and what happens is so if somebody's here, they might float back to here. They all start going back to the survival piece. So that you got to know that that core values can change. And yeah, I think just another thing about Dr. Massey, he basically had this saying about you are what you are because of what you were when. And what happens is if you go through some significant emotional event, it pushes your values to another area. Understanding that, you'll know more about yourself. Okay, so that's that piece. Excuse me, I'm just going to take some water here. So you can see some of these slides are for information. They're not on the test, but they're helpful. And then just a little bit about the Amazon project. This is an old slide, so it's not December the 6th, but here's some general theories, that will come into play, when you're working assignment number 4. Here's a thing about the questions, just so you know about assignment 4, and I'm probably going to review this again, but you're not to do all 29 questions. You're to pick out enough questions that satisfy 100 marks or more. Okay, so you can see this one example. They picked these particular questions. It happened to land on 100 marks. So you got to be 100 or just over. So another example, they picked these certain questions to answer. All right, and they got to 106. So I will mark this one based on 100 marks. This one marked based on 106, and this one based on 104. But here's the thing, is that I don't want to have to calculate this. All right. I want you to put this in your particular, as a table of contents in your assignment. So I see exactly what you've chosen, and I want you to actually add up your amount so that I can know exactly, I'm going to chart, I'm going to mark these according to, 100, and, it'll be the total of what you score over 104. So that's where that is. These are the questions. Here's the link. I'd suggest that it's going to be real tight near the end of June. So, start looking at this and start looking at, the participation activities that will help you answer these questions. Okay. Here's a little bit about, team activity and stuff, but it's really minimal, compared to what you can find, through AI and through, Google and other search things. But one thing that is key is Amazon's 14 leadership principles. And that may help you kind of understand how to answer some of those questions. And I think that's it. Okay. So anybody have any questions that are attending here that you'd want to ask? Just unmute. But again, I'll ask you to send me emails, and if the question I think can help other people, I will actually put the question on anonymously on announcements and answer it so everybody can benefit from the answers. Okay, and that's about it. And so we'll see you next week. And again, any questions about the participation activities, just drop me off emails and I'd be happy to explain. Okay. Okay, guys,